Good afternoon, ladies and gentlemen. Welcome back to this week's weekly market review. As usual, I have my handsome co-host, Mr. Gerald Wong, with me today. Over the weekend, a lot of things happened. The Israel and Hamas region go into a war again, and China is coming back from an 8 days holiday. Today, we have US, Japan, Korea, Taiwan on holiday, and Hong Kong in the early morning session was cancelled because of the weather. So a lot of things happening and a lot of markets on holiday. And of course, we had the big jobs data last Friday, where we saw at the beginning of the US market open, the indices actually tanked. But then towards the end, market actually rallied back and Dow was up close to 300 points. Gerald, will you be able to break down this job data for us today?
Sure. So I think you're right that a lot of things are happening in the market. We see the volatility in terms of oil prices, bond yields, and that is affecting the stock market as well. So those are the things that I'll go through in today's weekly market review. And as usual, because all of this is really for education and information purposes only, it should not be taken to be financial advice in any way. Okay, if you have more detailed questions that you want to be asking us after today's session, do consider joining the SIAS that is happening on 11 October. This is a webinar that is exclusive for SIAS members only. So I guess the next thing that I would want to be sharing with you is how you can be a SIAS member. You can leave us a Google review. That's something that we'll be appreciative of, but that will not actually enable you to be a SIAS member. To join, you actually need to actually go to this website. You can scan the QR code here or go to the link at the bottom, where for just $1 per month or $12 per year, you can actually get access to various benefits, including the SIAS session that is on a monthly basis. Okay, so with that, I will run through what happened in the market in the past week. So I think as you shared, there are many developments, and we see that being reflected in the share price performance of different markets as well. While we saw mixed performance across global indices, the performance has actually been highly volatile over the week. So if I were to look at the US market, it closed the week up. If I look at the S&P 500, it was up 0.5% last week, with most of the gains actually coming through on Friday. On the other hand, STI, as we shared in the previous week, it was actually one of the better performing markets. But in the past week, it actually came down by 1.1%. And we will take a further look as to what is driving the weakness in the STI. Okay, so what was really the focal point of a lot of investors last week was the US jobs data. This actually came through on Friday. And what we see here is that it will present us with an opportunity to understand how strong the labor market is in the US, okay? Because the US is a very big economy, and the consumer spending is a very important part of the economy. So understanding how strong the labor market is would present us with a picture around how the economy can potentially fare and what the Federal Reserve might potentially do in terms of its interest rate policy. So what we see here is that if I were to look at the latest numbers for September, the new jobs were actually at 336,000. And this would be the highest level since January this year. Generally, investors are expecting that the jobs data would moderate because of the thinking that with higher interest rates, it will lead to a slowdown in hiring activity. But what we see here is that the labor market is still very strong. And that actually led investors to expect that the Fed will have to keep interest rates for a longer period of time at a higher level. So Sunny earlier shared that the US market initially reacted negatively to this data because of the concern that interest rates will have to stay higher for longer. But what we eventually saw is that there was a bit of a rebound in the US market subsequently. The silver lining in this set of jobs data is that if we look at the sub numbers, the wage growth in September was a bit weaker than expectations. So that also presented one of the evidence to support that, oh, maybe inflation might start to ease if actually we see a further moderation in the wage growth in the US. So let us look at how has this actually translated into bond yields, which is something that a lot of investors are starting to take note of with the recent headlines that US government bond yields are at 16-year highs. Okay, so this is what we see here in terms of the 10-year government bond yield. We generally see that the bond yields for longer duration bonds have moved up more significantly for some of the shorter ones. So, for example, if you see here for the 10-year government bond yield, it saw a very sharp spike in the past month to now about 4.8%. If I were to look at the number actually just a few months ago, it would have been below 4%. So within a few months' time, it actually moved up very sharply. And that is really driven by the expectations that interest rates will stay higher for longer. So in case this 4.8% number might not seem so tangible to you, just imagine that if you were to put your money in a US 10-year government bond, you would effectively be getting close to 5% return per year in a relatively risk-free way. So that is driving the correction in the stock market, because of the fact that something that is seen to be relatively risk-free is now generating a higher return. And as a result, investors may not be wanting to take so much risk in the equity markets, or they actually require a higher return to be able to justify their investments. Okay, so what does this actually mean in terms of the US Federal Reserve policy? After the jobs data that came out, we see that there has not been any significant shift in terms of what investors are expecting for interest rate movements over the next 6 months to 12 months. But what we see here is that if I were to look at the June 2024 expectation of interest rates, it is now quite equally weighted between cutting to 5% to 5.25% versus keeping it at 5.25 to 5.5%. So it is not so straightforward that we'll start to see a rate cut from June 2024 onwards. And this is really reinforcing the idea that interest rates might actually stay higher for a longer period of time. So next, we'll take a look at how has this affected the Singapore market. Earlier, we saw that the STI actually fell in the previous week. So actually, if I were looking at the top gainers in the past week, I could not even find 5 stocks in the STI that actually had gains. Okay, I could only find 4 stocks here, and it was actually led by Singapore Airlines that was up 1.4%. We saw the banks doing relatively well. DBS up 0.4%, OCBC up 0.3%. This is on the expectation that they might potentially see better net interest margins if the interest rates were to stay higher for longer. We also take a further look at SIA later as to what is driving this bounce in the share price. If I were to look at the top losers, effectively, you have got a number of REITs here. So Mapletree Pan Asia Commercial Trust down 4.9%, Mapletree Logistics Trust down 7.7%. So overall, we saw that the REITs were very weak in the past week because as the interest rates continue to move up, there are concerns about potentially them incurring higher borrowing costs. And then at the same time, when something that is relatively risk-free, like the Singapore government bond yields actually start to be higher, it might actually make something like the REITs appear less attractive to investors because of the risk that investors need to be taking on to be buying into the REITs. Apart from that, we also saw Seatrium down 8.2%, leading the losses in the STI. And this is really driven by the correction in the oil prices that we saw in the past week. So a number of stocks that I will dive deeper into to talk about today. Mapletree Pan Asia Commercial Trust, SIA, as well as Vertex Technology Acquisition Corporation, which actually saw a major announcement last week. So I'll start with Mapletree Pan Asia Commercial Trust. This is a name that a lot of investors have asked us about because it is seen as a relatively blue chip REIT. But if I were to look at the share price over the past 3 months, effectively it is now at a multi-year low, having fallen quite quickly from above 180 per share to now $1.36 per share. So what is driving this weakness in the share price of Mapletree Pan Asia Commercial Trust? Okay, so earlier we saw the higher interest rates, and that is definitely something that investors are very concerned about for the REITs at this point in time. We see that being reflected in Mapletree Pan Asia Commercial Trust reported distributable income as well. So if I were to look at the first quarter FY 2324 versus the previous year, what we see is that they've been able to improve on their net property income. Some of this coming through from the combination that we saw last year as well. But what was very significant here is the increase in the net finance cost, which actually increased from 19 million last year to 54 million this year. So this is partly a reflection of the higher interest rates that we have seen that is leading to higher borrowing costs for the REITs. Okay, so that is why if you were to look at the distribution per unit for Mapletree Pan Asia Commercial Trust, despite the higher net property income, it actually came down about 13% compared to the previous year. Okay, so that is one of the key concerns for investors, how the higher interest rate is impacting their borrowing costs. And I think if I were to look at the distributions for Mapletree Pan Asia Commercial Trust, what you see here is that over the past few years after COVID, it has managed to see an increase in its distributions. But if I were to look at the first quarter FY24 numbers, earlier what we saw is that the distributions actually came down compared to the previous year because of the impact of higher interest rates. Okay, if you want to go get a full set of numbers, they are available on the Beansprout website, and you can actually look at how this trend of distributions have actually been over the past few years. Okay, but what is the silver lining for Mapletree Pan Asia Commercial Trust? What we see here is that the operating statistics for the REIT remains fairly healthy. If you were to look at the occupancy rate of some of their retail malls in Singapore, they are actually at fairly elevated levels. So if I were to look at VivoCity at 99.3% occupancy rate, so that is something that investors may still like about Mapletree Pan Asia Commercial Trust, in that actually some of their assets, especially the retail assets in Singapore, are still doing fairly well. Okay, so that is Mapletree Pan Asia Commercial Trust, one of the REITs that we saw a bit of weakness in the share price over the past week. Next, we'll look at Singapore Airlines. Earlier, we saw that it was the top gainer in the STI in the past week. So this is the share price of SIA, effectively reaching a high of about $8 in June this year, but then thereafter correcting because of the higher oil price that we saw, plus some moderation in the air traffic numbers over the past 1 month. But we see a bit of a bounce here in the past week, and that actually led to its outperformance versus the STI. So for SIA, a big part of what is now driving the share price is really this oil price movement. So if I were to look at the oil price, it actually saw this very big bounce between June and September this year. So effectively, that is leading to concerns that SIA would have a higher operating cost with the higher oil price. Okay, but what happened in the past week is that because of the concerns of a sharp economic slowdown with the higher interest rate environment, we saw a fairly sharp correction in oil prices, and that actually led to the outperformance of SIA. As Sunny shared earlier, we are now in a very volatile oil price environment. And with the recent political developments in the Middle East over the weekend, we started to see a very big bounce in oil prices again this morning. So that is something that investors have to keep a lookout very closely for, because it can affect inflation numbers. It can also affect different stocks, such as what we see for SIA here. Okay, last but not least, I wanted to talk about an important corporate event, which was Vertex SPAC. If you recall, there were 3 SPACs that were listed on the SGX early last year. So these SPACs are effectively blank check companies with the purpose of looking for a company to be able to acquire. So what we saw in terms of Vertex SPAC last week is that there was a big bounce in its share price after it announced a potential combination with a live streaming company. Okay, so that is something that investors have been looking out very closely for to understand what are these companies that the SPACs will actually acquire. So what they actually announced is a business combination with a live streaming company called 17 Live, which is one of the leading live streaming companies in Asia Pacific. Okay, so with that, they believe that they'll be able to combine their different expertise and bring value to shareholders. Okay, if you have not heard about 17 Live, this is something that I extracted from their company presentation. Effectively, they are a leader in the live streaming platform in Japan and Taiwan. And effectively, what they want to do is to be able to expand into Southeast Asia. What we see in terms of the number of stats is that they have close to 87,000 contracted streamers globally. And if I were to look at how engaged the users are on their platform, in terms of the average daily view duration per daily average user, according to the numbers from the company, it is at about 93 minutes. Okay. In terms of the financials, what the company has reported is that they are adjusted EBITDA positive since 2020. Okay, so effectively, this is in a nutshell what 17 Live is about. And in terms of what to look out for next, we saw that the announcement of the combination has been announced last week on 2nd of October. Now we are awaiting for the companies to dispatch their circular, which is expected to be in early November 2023. Thereafter, there will be EGM expected in early December 2023, but this is subject to SGX approval, in which the holders of the SPAC will vote as to whether they approve of the transaction. And if the approval is actually received, then the completion of the business combination is expected to in December 2023. So this is something that investors can look out for over the next few weeks to understand how this corporate development will actually pan out. Okay, so we have a very strong lineup of economic data in the coming week. In this week, we will have the Singapore third quarter GDP data, and together with that, the MAS monetary policy statement. There are a number of different events that are coming up this week as well. Effectively, if you are interested in SPACs, there's a SGX Academy webinar that's happening tomorrow for you to understand about the SPAC and the transaction that I spoke about earlier. For the dialogues with the corporates, we also have a dialogue session as a SIAS Corporate Connect to be able to help you understand more about CapitaLand Escort Trust. Last but not least, we have a SIAS webinar where I'll be bringing you through how you can combine fundamental and technical analysis, and that is happening this Thursday on 12th of October. We also have the US CPI data happening this Thursday. And last, also, we have the US earnings season coming up with the big banks, Citibank and JP Morgan starting to report their earnings from Friday this week. Okay, so quite a number of different things to look out for, quite a number of different education events that you can participate in. So do join us in this event as we help you to understand how we can be better investors. So with that, I'll pass over to Sunny to help us understand where we are in terms of the stock market performance now, and how we can potentially look at some of these technical indicators.
Okay, thanks, Gerald, for sharing with us the details that happened in the market last week. And of course, the job data, what happened in the US market in the early part of trading, where the market seems to be reading the headlines and market starts to go down. And after reading the tea leaf and the details is in the devil, the wage growth is not that strong. So market take that as a positive and went back up. So I will come to the US indices in a few minutes, but first things that happened over the weekend. Hamas launched an attack to Israel, and then now there's a war in the Middle East already. Of course, the first thing is the flight to safety. We can see that gold price actually went up by about close to 1% this morning trading. And let's look at the oil price as well to have a latest update on where the oil price is right now. It's at about $86. So it comes down from the high of above $90, which is the beneficiary of SIA. So SIA actually benefited from the retreat in the oil price. And of course, Citrum was not the beneficiary, but was affected by the drop in the oil price. So you can see that oil price actually affect quite a few counters on our STI index. But of course, the conflict that happened over the weekend and the jump in oil price this morning, I believe still have not factored into the stock market yet right now, or even the inflation data that is coming up this week on Thursday. So I'll come to the STI shortly. There are a few holidays this week. In US is a holiday tonight, and of course Japan, Korea, Taiwan is also on holiday. Hong Kong this morning is suspended because of the bad weather, a typhoon warning. So I'll start with the US indices first. So we have been speaking for a few weeks or a few weekly market reviews that is it time to go back into the Dow Jones index already, or the US indices already. In the past week, I'm saying that we still need to wait a little bit more, but we have saw that the RSI indicator actually triggered the oversold signal on 3rd of October, which is last Tuesday. Thereby, this is the first signal to tell us that yes, we are ready to go into the market, or the market is actually in oversold territory now, at least for the Dow Jones index. The second indication that I'm getting from the indicator is the MACD indicator. You can see that the MACD indicator line, the blue line, is starting to converge towards the signal line. That means that the downside momentum that we observed so far in the Dow Jones index since the peak in August is actually starting to subside already. So both of the indicators are telling us that market is starting to turn up right now. But of course, this is as of the latest reading on last Friday, okay, which does not take into account the conflict that happened over the weekend. So there might still be a bit more of a hesitant in the rebound that we see in the Dow Jones index. And of course, the Middle East conflict is still developing and how that might happen. But of course, I will still stick to the previous thesis that we have been sharing. I'm looking at the support level over here, which is the May low of 32,586 points. That is the support that I'm looking at. So with the conflict happening, then the pushing up of the oil price due to the conflict, I think the Dow Jones index will not fly up really soon or have a big rebound, but probably we will need to have some time here to consolidate. And this level of 32,586 could be a point where investors over the long term that wants to go long can try to consolidate around this level, 32,586 points. Next, let's move to the broader S&P 500 index. Previously, we were talking about this double top or even a triple top over here, which is around the 4195 level. I'm saying that this is the support level that I'm looking at to get back into the S&P 500. We have not touched that level yet, but we have crossed the one of the important indicators, which is the red line that you see here, which is a 200 days moving average. So 200 days moving average is actually a long-term kind of measuring of the average price of the index. So this is a strong indicator or a very strong support for the S&P 500. And as you can see, last Friday, we have a very convincing close above this 200 days moving average. And combining this with the long-term uptrend that you see over here, the green line, combining the low of October last year as well as the low of March this year, the S&P 500 is actually on a very firm footing. And of course, this is a good time now to consolidate for the S&P 500 for a bigger rebound in the later part of this year or even early part of next year. So the indicators wise, we have seen a very prominent convergence of the MACD line towards the signal line. This signals to us that the downside momentum that we observe in the S&P 500 is actually subsiding very aggressively. And if let's say the MACD line cross above the signal line, that could be the confirmation that we have a change in a trend now, where the downtrend that we observed since July for the S&P 500 is starting to have a change in direction. Yes, the RSI indicator on Tuesday also breached the 30-point oversold level. The lowest on Tuesday, we saw the RSI go to the 28 points level, and now we have seen the latest reading on the S&P 500 shot up to 43. So once we cross above the 50-point neutral mark on the RSI, it will signal to us that we are starting to gain positive momentum already. So the 4,200 handle or the 4195 level would actually be a very good support for the S&P 500, and it so seems to me that now is the time to get back into the S&P 500. Not saying that we will see a big rebound soon, but likely this support is likely to hold 4,200, and probably we will consolidate here first before we get more clarity on the Middle East conflict as well as the big inflation data that's coming out this Thursday. Okay, next let's move to the tech-heavy Nasdaq Composite Index. Now, the pullback in both the Dow Jones and the S&P 500 in the past few weeks is actually pretty steep, but it does not affect the Nasdaq Composite Index as much as the other two indices. So this signals to me that tech stock is still the major growth area that we should be looking at going into the end of this year. So the Nasdaq Composite Index actually used the support level over here, the low of August, as a support and closed above that quite convincingly last Friday at 13,431 points. The support that we are looking at here, which is the low of on 18th of August, is actually around the level of 13,161. So the 13,000 handle is actually a pretty strong support for the Nasdaq Composite Index. And this is also very prominent, as you can see here, the red line, which is the 200 days moving average, now reading at 12,931, is slightly going to inch up slowly. Thereby, the 13,000 handle is actually a good support for the Nasdaq Composite Index as well. Okay, and of course, the MACD, we already have a confirmation that we may have a change in trend because the MACD line has actually breached above the signal line already, and we are seeing a positive MACD histogram reading right now. So this confirms that the change of trend that we observed since the middle of July, this downtrend, a counter trend to the primary uptrend, is actually a change, having a change in direction right now, and may continue to trend upwards on the support trend line here, the green line combining the low of December as well as March this year. So the RSI indicator, the latest reading is at 49, so about 0.5 or 1 point away from the 50-point neutral mark. Once we go above that, the positive momentum may start to build again. Okay, so the lowest that we saw on Tuesday, the reading was 31, so we are 1 point short of the 30-point oversold signal. But then if you observe the history of the Nasdaq Composite Index in the past few months, you can see that whenever there's a bounce on the index itself, it actually does not touch the 30-point oversold signal. So coming very close to this 30 point is actually a signal to me already that it has been one of the lowest RSI reading for the Nasdaq Composite Index this year already. And this rebound that I see, if it crosses above 50, would give me a very strong confidence that we are going to see a rebound or a trend going back up soon following the primary trend that we observe over here on the green line. So we have been talking about a few weeks that whether is it time to go in yet? Is it time to go in yet? I think it's time to dip our toes into the water right now, at least on the 3 US index. Okay. So next, the S&P, the Hang Seng Index, we just came back from the holiday on the Chinese markets. So Hong Kong also have a short trading week last week as they also celebrate the National Day holiday on 2nd October, Monday. And we have also seen that economic data starts to improve. So the green shoot that we observe over here on last Friday is actually a good signal to me that market has actually sort of bottomed out already, but we have not crossed above this double bottom kind of formation, I would say, over here. Or maybe I should delete this line because this is a sort of a downtrend. But seeing that we have a little bounce on the Hang Seng Index right now, and the MACD indicator seems to suggest that the downside momentum is starting to subside already. This could be an area where the Hang Seng Index could actually consolidate as well. On the RSI, the reading at 43 now is also not telling us a lot of indication right now, because based on the 14 days moving average reading on the RSI is about 40 points as well. So past few weeks it has been sort of consolidating on the RSI. And we are looking for a trigger somewhere over here that if the RSI can go above the 50-point mark, that will be another confirmation from the indicator that we will be seeing that a positive momentum starts to build up again on the Hang Seng Index. So also a good point to get into the Hang Seng Index. Not say that to go in all in right now, but it's good to dip your toes in and starts to sort of accumulate on the Hang Seng Index as well. Next, let's move to the STI, which is one of a few Asian markets that is open today. So we can see that we have a bit of a pullback in early morning trade. We are now down about 0.3% or 9 points. So I believe this is us reacting to the news of the Middle East conflict right now. So we said earlier that which support level that we are looking at is a 3155 level, which is the low that we observed on 31st May. Okay, so this thesis that the support level at 31st May at 3155 still stands. And we've seen last Tuesday or last Wednesday, SCI reached a low about 3134 level on 4th October, and thereby breaching this 3155 level. But then we see that the next few days on Thursday, Friday, SCI actually bounced back up above this level. This signals to us that the 3155 or the 3150 level is actually a good support for the STI index. And combining this with the uptrend support that we connected on March, as well as July and August of this year. So this is more of a triple bottom kind of a support for the STI index. You can see that this support line is actually very strong holding that right now for the STI to consolidate around this level, the 3150 level. Now STI is trading at 3165, so it may be a good time to go in right now on the STI index as well. Of course, major components of the STI index is the 3 local banks. With the highest interest rate environment, it's also a good sign that our banks will be making more profits going forward because of the highest net interest margin that they can earn due to the highest interest rate environment. But on the MACD indicator, we see that the MACD line is sort of going into a sideways or a range bound kind of direction. Of course, the MACD histogram shows that the downtrend momentum is subsiding. So this will take a bit of time for the consolidation to complete before we see a bounce back up. Of course, RSI is still weak, reading at 39 points, but we can see that it's starting to bounce back up from the low on Wednesday at the reading of 32. So it's going to be dragged out for a bit of time here on the Straits Times Index as well, but definitely the 3150 will be a good support level to think about getting in to go long on the STI. So that is my take on the major indices. Any comments, Gerald?
Yeah, so I guess there are quite a number of different things we need to look out for as investors this week. There's the US CPI data, oil prices remain highly volatile. We also have the MAS coming up with their monetary policy statement. In the meantime, we are starting to go into the earnings season. So investors would have to look out for some of these events to keep themselves abreast of what is happening in the market. At the same time, we have different educational events that are happening this week to help you as investors as well. There's the SIAS, there's the Fundamental and Technical Analysis Workshop. For those who are interested in specs, there's a training on that as well. So do take part in these events and equip yourself better as an investor so that we can understand how we can make sense of what is happening and become a better investor.
Okay, seems like it's going to be a busy week ahead for everyone. And of course, just a reminder, this Wednesday, we are having our SIAS event. If you have any questions for us on the capital markets, do join us as a member and we'll see you again on Wednesday. So that's all we have for this weekly market review, and we'll see you again same time, same place next Monday on the weekly market review show.